Hi guys, welcome back. So, in my video last night, I talked about how a lot of the Chinese stocks had still outperformed a lot of growth stocks in general because I do believe they were undervalued and attacked by a lot of the political issue, and also how we were driven by emotion and manipulated by the market sentiment. And then I used the example of NIO to analyze the whole year of price action from the beginning of last year, 2020, and how a lot of news and political issue attacked the share price. And from there, we can see that the news about the HFCAA, the Holding Foreign Company Accountable Act, has been used a few times already. See, 1, 2, 3, 4, to create panic selling. And then meanwhile, every time the share price would bounce back up the support and continue the upward movement in the past. And this time it's different because it drove the share price down below the support for quite a few days instead of bouncing back up right away and continue the upward trending. And for this, I have summarized it into 5 reasons that I think would be possible for this big correction of the Chinese stocks. A lot of the Chinese stocks were down quite a lot recently. So here it comes. Number 1, it's possible that the smart monies are hedging for the uncertainties. So because the US and China had signed agreement previously when things were good back then about how the US would allow the Chinese listed companies to provide what they're allowed to for auditing, which would avoid all the sensitive content that the Chinese side would not want to review. And when the two countries got more tense, this agreement had been voided. And now the new law of the Holding of Foreign Companies Accountable Act has been passed through with the new US president. So it does look like the two countries need to renegotiate and settle down some of the terms and see which side can bend over a little bit or both sides to adjust each other. So it would be normal for the smart money to exit first and wait on the sideline to hedge against the uncertainties coming up. And then number 2, it would be some money are taking profit already because, as we explained last night, it was just way too much of a run-up for a lot of the Chinese companies, like for example EH. It has simply just run up too much, 500% plus in just over a month. It was too much of a run-up, too much hype going on, and possibly too much speculation on how the new US president would void this new law that was introduced by the previous president. So usually after a big run-up, it would need a serious cool-off. It might take a long period of time because a lot of people still have the expectation and the excitement from the previous run-up. So that's why sometimes the stronger the run-up, the longer it needs to cool off. If that's the case, how long would it take? No one can give an answer because sometimes it can be really harsh and deep at a fast rate for people to get scared away and exit their position or cut loss. Sometimes it can just go on the side for a long time. For example, a lot of the FANG stock had a great run up last year after the COVID crash. And when everybody expected to continue going up, it instead would go through a long period of cooling off. Like it can take months, like Amazon, right? It grew more than 100% in just a few months, which is very strong for a mega cap company, over $1 trillion. So afterwards, it just spent a few months to go on the sideways to cool off. You can say the bigger it jumps, the longer it would take to cool off. It doesn't necessarily have to drive down with a big hit, but it can use time to digest this need of the cool off. Just like last time, it had a good run up until 2016, and then it took 4 years for it to bottom in 2020 before the big run up again. We can also use a Chinese stock as an example. Let's look at JD.com. If we zoom out and we see all the way back to a few years ago, from 2016 to 2018, it had a nice run up from $19 to $50. That is 150% of growth in 2 years. And then it had peaked during the trade war between the US and China in 2018. And then it took 2 years for it to bottom. We see that it was dropping slowly, the A, B, and C, back to $19 after almost 1 year. So imagine if you were trapped at the top, you then need to tolerate this slow drop for almost 1 year until it's more than 60% of losses. In this case, it would be the macro environment and the overall market driving the individual stock more than the fundamental of the company. So we can see sometimes it can take really long for the sector to cool off after a strong run up like this. Are we experiencing something similar right now? In 2021, after such a nice run up within the recent months, are we seeing the sector of Chinese companies slowly dropping like the ABC we have experienced before? Or taking a sideway for quite some time like the FANG stocks in the last few months? Is the new SEC law acting like a trade war 2.0 to the sector? There's always possibilities, so this is why you need to ask yourself a question. Are you prepared for this? It took a bigger hit to a lot of Chinese stocks than previous times because we knew last year we were in a bull market and everything was still going uptrend. Even though the news of political issue had attacked these stocks quite a few times, it was still overall an uptrend within the bull market. So right now, at this moment, a lot of stocks would rely on the sector and the sectors would rely on the macro environment. But if it's this reason, then you really need to think about whether you can take it to see your stock dropping slowly for a while. You need to ask yourself whether you have strong conviction on this company. This is why I reinforced a few times that I would focus on my top 5 holding because first of all, it will allow me to be more focused, to be more simplified, because I invest in them for the long-term vision of these companies. And because of the strong conviction, I can forget about the short-term movement because a lot of the times people are not clear whether they're investing on this company for the long term or the short term. Because a lot of people might have planned to hold it for long term in the first place, but when the share price drop, they would tend to ask, why is it dropping today? Why is it dropping this week? Is this company not good anymore? Does that mean the Wall Street would keep forgetting about this company? Does it ever have a future? But the truth is, any good companies would experience a period of time of falling, just like any bad companies would have a period of time of rising. This is the stock market and how it works. So you need to know sometimes stocks just keep dropping, and it's not because the company is bad. It's simply because there is a cycle of different periods. So that is why when I focus on my top 5 holdings, then all the rest I can just take it easy, treat it as a shorter to medium term when the market goes south or when we get into a bear market. For example, I have said it many times that for JKS, I would set a stop loss below the 250 moving average. And right now it has been touching the 250 moving average for a while and has not broken through it yet. So does that mean I don't believe in this company? No, it's not because of that. I do think this company is quite undervalued. We see that the PE ratio is quite low compared to other players in the same industry. It is an undervalued company. It is in a rising industry, in a rising market. So nothing fundamental has changed. The only thing is that I want to simplify my portfolio, my strategy when it comes to the bad weather. Because sometimes when a stock drops below the 250 moving average, like if we pull up JD again, back in 2018 when it dropped below the 250 moving average, we can see that in this case, it really took a long time to recover until it get back on top again. I'm not saying this would happen to the stocks right now. I'm just saying that keep in mind there is possibility like this, and you need to know whether you are prepared for this. And if not, this is when you put a stop loss for the companies that is not in the top of your list. I guess everybody would have their own habit and different level of conviction on the companies they're holding in their list. So you can decide from here when you are prepared for the worst case scenario. And number 3, I think it would be normal for some capital to start moving to the foreign market if the political issue does not get addressed. So recently we have been seeing a trend, a wave of some Chinese companies getting second time listed in the Hong Kong market. Like for example, Baidu was listed in Hong Kong since the end of March, and then Bilibili was second listed in the Hong Kong market since last week. And then we see that the 3 EV companies, NIO, Xiaopeng and Li Auto, might also be planning the second listing in Hong Kong market at this moment. So because of the recent political issue had raised a lot of uncertainties, so it had triggered a wave of some major Chinese companies planning on their second listing in the Hong Kong market. So I think it would make sense for some institutions to start pulling out their money to invest in the Chinese companies in the US stock exchange and move it to the Hong Kong market, because it would for sure not be affected by the political news. Because even if these Chinese companies would for real be delisted, if it does not comply with the HFCAA, it would not affect the listing and the share they're holding at the Hong Kong market. So it makes sense for them to move this capital and wait for the entry in the Hong Kong market. In fact, we have started to see this trend. For example, we see that since a few months ago, the Alibaba institutional investors had started to already swap their US shares for Hong Kong. For example, the Temasek Group Holding and the Bailey Gifford, because it's just simply a safer environment for the Chinese stocks at this moment. Especially with the recent rebound of the US dollar, it would make more sense for the capital to flow out of the US and swap the shares to the Hong Kong market share. So in between, they can even make more with the currency exchange. So that is reason number 3. It makes sense for institutions to swap the shares to foreign stock exchange for the Chinese stocks, such as the Hong Kong market. And number 4, because last year the Chinese stocks were under attack for a few times by the political news already, and every time it had been recovered. So there's a possibility that some retail investors are quite trained to counter the fear already. So this time they are taking a bigger hit than needed to create more panic effect, even though it's been the same news repeatedly being cooked over and over again. And then reason number 5, so far the news of the Holding Foreign Companies Accountable Act has been used as a bad news over and over again for several times already. And we all just kind of accepted that it is a bad news for a lot of the Chinese companies. But have we ever thought about the other possibility, the opposite direction? That what if it's actually a good news? What if it's not a bad news at all? Think about it. Even without this HFCAA law, the Chinese companies had always been undervalued. Why is that? It's because there's always the fear of trusting Chinese companies in people's mind. There have been trust issues for Chinese companies for a long time already. And the fraud case from Luckin Coffee just gave it a final kick, a final push. So if the two countries had finally come to an end agreement and the Chinese companies would actually comply to the US auditing rule, from the PCAOB, which is the Public Company Accounting Oversight Board. That would be a giant great news for most of the Chinese companies, because it would be solving a lot of the trust issues on Chinese companies from international investors. Because we know the book has been audited and it's 100% real. And if that happens, the valuation of the Chinese companies should really go back to the normal sense. And that would mean even more explosive growth. Like, for example, Alibaba should really grow back to the normal valuation where it should belong, because it's just insanely undervalued compared to Amazon, considering they're both growing at a fast rate and expanding their influence cross-industry and into new technology and emerging market, gaining their international influence as well. So for now, it's super undervalued because there is too much political concern, because for this giant company, we may not be clear about the overlapping with the government. So in the Holding Foreign Companies Accountable Act, released by the SEC recently, we can see that even though it says foreign companies, so it's not 100% targeting Chinese companies. It's more like all the non-US companies. But in between the background written, when we look in detail, it does says specifically the Chinese Communist Party several times. So this says if the company has any official of the Chinese Communist Party to be a member of the board of directors, and if the articles of the company contain any charter of the Chinese Communist Party, would be subject to additional disclosure. So these two terms would be directly targeting Chinese companies in this case, and might be the most difficult for the Chinese government to swallow, because even though it's named the Holding Foreign Companies Accountable Act, but in the small text it directly point out the Chinese Communist Party. And this might have touched the pride of the government, and I hope they can find ways to work around with it. Because right now, there are a total of 200-something Chinese companies listed in the US stock market and totally accountable for more than $2 trillion of market cap. And if this is all removed and back to Hong Kong market, it would for sure hurt the US stock market as the center of the financial world, and instead help the Hong Kong financial market to gain more international influence. Because we know it's quite attractive to invest in a lot of the Chinese companies, as Chinese market is the biggest market and also one of the fastest growing market, and we know a lot of the new tech would emerge in China for the next decade. So it would be attractive for institutions regardless of the political issue anyways. So it doesn't seem like the best interest for the US government to want to delist all the Chinese companies. So I do think it would be necessary for the two countries to work around the agreement. For now, from the look of it, within this short period of time, we do see them started to exchange favors. First, in February, we see the Chinese government is in consideration of allowing investment in overseas stocks at foreign exchange. An individual can spend up to US dollar of $50,000 per year on foreign currency purchases. And because US has the biggest financial market, and it would make sense for this law to benefit the US the most. And we did the math before. If this can pass through, we might be seeing hundreds of billions of dollars adding in the foreign stock market every year. Because right now, most Chinese people invest in real estate and not too much in love with the Chinese stocks market. Because the companies listed in the A-share or the Shanghai Stock Exchange are not as attractive as the Chinese companies listed in the US stock market. So this, to me, looks like a favor in exchange for negotiation. And on the other hand, we also see the news in March about the court ruling suspends US ban on investment in Xiaomi. So Xiaomi was blacklisted by the President Trump as one of his last acts before he stepped down the presidency on January 15, 2021, which was 2 months before this news. And 2 months later, Xiaomi had won the court hearing, and the judge had temporarily blocked the Department of Defense from forcing American investors to divest from Chinese smartphone maker Xiaomi Corporation on the ground the company has tied to China's military. And not only this, but also the judge had called this list unlawful and unconstitutional, and even claimed that it is arbitrary and capricious. So this was a blacklist from the previous president. And if the White House did not agree, would the judge overthrow this with such strong and clear standpoint? So it does seem to me that both sides have been exchanging favors. And if this continue, I see them working it out eventually to come to the agreement. So yeah, that's why it's my fifth reason, the fifth possibility. If the two sides can come to an agreement, it would indeed solve a lot of the trust issues and political risk that was always serving like a time bomb for a lot of Chinese companies. And that would be an insane good news for the Chinese stocks, because it would mean they need to be evaluated as a similar way as the US companies. And they would most likely have higher valuation than currently, because a lot of them are undervalued at this moment with the trust issue and political risk. So yeah, I do see the possibility of it this time being a potential good news. And if that becomes true, that would make this wash sale a final wash. And usually a final wash is harder than normally to shake out more people. So that would sum up the 5 reasons I have come to for the bigger hit of Chinese stocks recently. So let me know in the comment section, what do you think about this? And which do you have more reasons that I left behind? And which one do you think is the most possible case right now? And what is your plan? I am quite eager to know. And if you have enjoyed this video, please give me a big like and write me a great comment. And I will see you tomorrow. That's it, guys. Hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.